My name is Hammer. I am your mortgage rate market guru. It is February 21st, 2024. We are here to talk about what's going on with mortgage rates this week. So remember, if you're watching on the replay, do me a favor, put in a hashtag replay. Let us know that you were here. We do monitor the post, so if you have any questions, go ahead and ask your questions or share any thoughts that you do have. So let's go ahead and jump in and talk about rates for the lend. When we talk about rates, we're talking about generalities, and you should always want to make sure that you do go ahead and shop your rates. So let's first do a quick recap. So last Wednesday, on February 14th, Valentine's Day, we were not in love with rates. Rates had moved higher. VA rates were generally in the mid to high sixes, with conventional rates generally in the low to mid sevens. Now, your VA rates, those are if you're getting a VA mortgage. If for any reason you're not getting a VA mortgage, that's when you're generally going to find yourself getting conventional rates. Now, today is the 21st. Rates are about the same. They've been pretty consistent over the last week. VA rates generally are still in the mid to high sixes, and you'll find that can vary based on credit score and your particular scenario. So make sure you talk to a mortgage professional. But conventional rates generally in the low to mid sevens. Again, that can go up into the high sevens depending on credit score, even the eights, depending on if it's an owner-occupied property or if you're using it for another purpose. So what's affecting rates the last couple of weeks? Well, we've got inflation data has been a big one. Last week, we had consumer inflation data as well as wholesale inflation data, and both of which were not good for mortgage rates. So last Tuesday, we got the consumer price index consumer inflation data, and it showed that inflation had been actually moving up a little bit instead of continuing to move down. And that caused mortgage rates to take a jump. We really saw mortgage rates move higher at at that point of last week. Also on Friday, the wholesale inflation came in much, much higher than expected. And the last couple of readings have been very good for wholesale inflation. Now, inflation is bad for mortgage rates. It's bad for all rates. And that's for a couple of reasons. Number one, inflation makes today's money worth less in the future because you can buy less with it. So mortgages are actually part of a larger ecosystem of lending. And if I'm collecting interest today, that 5 or 6 or 7% interest, well, if I'm getting 7 cents on a dollar today, and those 7 cents can buy me a candy bar, but in 2 years, because of inflation, candy bar costs 9 cents. Well, that's why inflation is bad for mortgage rates. That's why it's bad for investments. Also, it's bad because we're looking at what's going to happen with the Fed. And that's the second thing that's affecting rates right now is mortgage rates can't fall significantly from here until we see expectations increase for a Fed rate cut. Now, what I want to show you here, let me pull this up. I'm going to pull up my handy dandy iPad here. And let me pop this on screen. Let me show something with you. And I want to show you what we're looking at here. So let me go ahead and flip this around. Let's see when this pops up. All right. So right here, what you're seeing on this on my iPad screen is we're looking at what are the probabilities that the Fed is going to cut rates at future meetings. Now, up along the top here, you can see that if I zoom in, we've got a meeting on March 20th. We have a meeting on May 1st. We have another meeting June 12th. And basically, the expectation in March, right now, rates are at, let me go ahead and set this for markup here. Hold on a minute. I just got to, there we go. All right. So I'm going to, where's my markup tool? I'm playing with this. This is my new iPad. So I wanted to show you guys. So we're going to go ahead and take a look here. If you look here, 5 1/4, right? So this is our magic number right here is at 5 1/4. And right now the expectation, there is a 94% expectation that at the next meeting, which is in March, this is the March meeting that we're looking at right now, there is an expectation that that will remain at 5 1/4%. And that's kind of what is killing us here. So if we take a look and we go to that May meeting, well, at the May meeting, and let's do the same thing. Let's go ahead and play with my little markup tool here, and I'll show you what we got going on. All right, so here we are. Now we are looking at the May meeting, and at this May meeting, we are looking at about a 70% belief that we will stay at 5 1/4. So there's about a 30% expectation. You see that right here, right? That we will actually go ahead and see rates drop and see that Fed cut rates in May, but that's not very much, not very much at all. And let's go ahead and get rid of that one, and let's go to the June meeting. And if you take a look here, let's do this one more time. Let's get to the markup tool. All right, so if we take a look here at this June meeting, and again, this is months away, but markets are looking at in June that we're going to go ahead and we have a much higher chance of seeing a Fed rate cut in June of at least 0.25%. And right now, markets believe that there's only about a 25% expectation that we will see the Fed continue to keep rates the same as we head into June. But that's a long ways away, and that's kind of our problem. So right now, the expectation is we're not going to see mortgage rates really drop back down significantly. When I say significantly, I'm generally talking about 0.25% from here. And we're not going to see that happen until we actually get a higher chance of a Fed rate cut. So that's kind of where we're at. As far as where our forecast is, what are rates going to do over the next few weeks? Well, first of all, in the next 15 days, right, next 2 weeks, right? We've got the first, let's see, we've got one more week of February basically, and then we're heading into March. Now, rates are likely to stay near their current levels, right? Which we talked about before was generally in the, let's see, rates, current levels, mid to high sixes, low to mid sevens, depending on whether you're looking for VA or conventional, right? So rates are likely to stay near those current levels. And although they're going to move a bit day to day, and they do move day to day, we're not likely to see any big moves higher or lower here. Now, over the next few weeks, rates are not likely to move much until the March 8th labor data. And that data comes out early morning, Friday, March 8th. And that's when we're going to be most likely to see the next big move. There's two things that the Fed is looking at to decide when they're going to go ahead and cut rates. And again, mortgage rates can't fall until markets expect that the Fed is going to go ahead and cut their Fed funds rate. So the Fed doesn't set mortgage rates, but they very, very strongly influence them. And mortgage rates, if we want to forecast where we're going to be, right now the biggest indicator and the biggest factor that's having the most effect on mortgage rates is going to be the Fed. So the Fed, they're looking at labor data, which last month's labor data, which came in February 2nd, smashed expectations, came in much stronger than expected. And many economists, many pundits out there don't believe that the labor market is nearly as strong as that data that came out said it was. And that data was adjusted. Now, I'm not saying the data gets maliciously manipulated, but it does get adjusted. There's seasonal adjustments. There were changes made to how it's adjusted, and the readings just came in through the roof. So the next report comes in a month later, and that's going to be on March 8th on Friday morning at 8:30 a.m. Eastern time. Now, if that report were to show labor market weakness, and that things had maybe less jobs created, revisions to the last report that showed less jobs were created than what was initially released, well, that would be good for mortgage rates. It's going to help them to creep a little bit lower, to move a little bit lower from there. But it's not a given. It's not a guarantee. So if you're out house hunting right now, you don't have to worry too much. But if you're under contract, you've got a decision to make as far as when you close. If you close in the next 15 days, you're likely to see rates that are going to stay very near the current levels, maybe move a little bit higher or lower. You may want to discuss locking in with your mortgage professional. If it were my loan, my personal loan, I would strongly consider locking in for protection because it's more likely we see rates creep higher from here than creep lower. As far as the next few weeks, rates are not likely to move much lower until we get that March 8th labor data. And then just a couple of days later, we're going to get the March 12th inflation data. Remember, last week's inflation was showing inflation was not slowing down as quickly as we want. And we have to wait and see that next report, hopefully showing stronger inflation going down, inflation improving, less inflation, which would be good for mortgage rates, and we would see some improvement there. As far as the longer-term picture goes, we're not going to see mortgage rates drop like a brick anytime soon. They're not going back to pandemic lows, but we do expect that at some point, we're going to see rates start to move a little bit lower. And we have since last October. Now, remember, last October was when we saw our absolute worst mortgage rates, and that was right after the Fed had finished raising their Fed funds rate. So then we saw what was called a pivot around the end of last year, around December, where markets, economists, traders, the Fed put out information that's okay. Basically, we're raising rates. Now we're going to look when we want to cut rates. And the reason the Fed needs to cut rates is if they keep rates as high as they are, eventually they are going to slow down the economy. When you raise interest rates, it slows everything down. It slows down spending, slows down borrowing. And the Fed wanted to do that in order to get inflation in check. But now that they are getting a handle on inflation, they need to kind of take their foot off the brake and let things improve again. And that's where we're at. So anyway, if you have any questions, go ahead and put them in the comments. I'll be glad to answer them for you. Always appreciate all of you. Remember that I am here each and every week. You can join me live, or actually not live, doing these recorded now. This one today, I am live today. However, I am doing these recorded now, but you can join me each week at 12 p.m. Eastern time when these are released. They'll be available in the Facebook group, so you can find them in the YouTube channel. You can reference them anytime. And if you have questions about what's going on with mortgage rates, and whether it's a good time to lock or float, or whether it's a good time to go out looking and house hunting, let us know in the comments. I'll be glad to answer those for you. So I'm going to start giving you a little bit more information as I come each week, maybe giving you some more background on how mortgage rates come about, why they change, how they change, what you can be looking for, but want to keep you informed so you can make great decisions for yourself. All right, everybody, thank you so much. Appreciate you joining me. Hope you have a fantastic week. I'll see you next week. Bye-bye.